Let's take you to Simon Mariner from Aliom Financial Markets, standing by in our Sydney CBD bureau. That was an 8-month-week finish on the street. Simon, it's all fear-driven. What's going to turn around the equation, or are we just going to be range-bound till Friday's jobs report?
Yeah, certainly. As you said, markets generally either driven by fear and greed. It was fear that gripped the markets overnight. The S&P off 3.1%, the Dow tumbling 2.7%. It all really started, I think, with China, or more importantly, the prospects for growth out of China. A leading index revised there. They're going to face some strong headwinds, I think, in the back half of this year in terms of their exports. Certainly the tightening of their policy, and also Europe potentially not consuming as much as historical is going to be hard for them. US consumer confidence kicked in 10 points lower, a lot lower than it was expected, even below the lowest of the economists' forecasts. And also there was the potential, I think, for investors to exit the market or pull some money off the table, a bit nervous or skittish about this Friday's employment figures. So all in all, we expected treasuries to rally. They did, and oil and commodities were off across the board also.
Cue for a bit of much-needed jawboning from the Fed and from Barack, but so what?
Yeah, fresh face back from the G20, Obama and Bernanke saying that they see strength in the US economy. Obviously, you've got to look pretty hard for that, but there are certain sectors, you could argue that were showing the right signs of recovery. But more importantly, they were talking about their own headwinds coming from Europe and the events coming out of Europe. G20, I think, was really all about trying to calm some of those fears. The leaders agreeing to halve their deficits by 2013, stabilise their output to debt ratios by 2016. They're trying to convince the market and investors that these sorts of debt crises and risk of sovereign default, they won't pop up again. But for my mind, 2016 is a long way away, and I think the investors are more concerned about the here and they're more concerned about the now.
Has Barack got the blinkers on, Simon? I thought at G20 was saying don't export to the US. We're not the gravy train we once were.
Yeah, look, it's a good point, and interestingly, if you look at the manufacturing leadership of the world, that does still sit with the US. I think they produce 19.9% of global output, but China's very close behind. They're at 18.6% of global manufacturing output, so they're creeping up on them. We do expect them to take over, but the interesting question potentially is not so much where it's made, where's it sold and who derives the profits.
Yeah, speaking of China, Forex markets sort of wanting to key off PMI data, the manufacturing print. We could test support, PMB Paribas says, at about 84.70 if that disappoints on the downside. What's your view?
Yeah, look, the Aussie dollar certainly lower again on the back of that risk aversion. It was flirting in the 84s. I think it's just above 85 as we speak now. Look, the last few weeks it's been well supported. It's been driven higher. It's not been about the global sentiment story. It's been about the loosening of the yuan, which was good. Closer to home, the resource super profits tax potentially helping our all-important Australian resource sector. But today it's a barometer for risk. It's showing that risk aversion being played out. But also in the general weakening in the commodity markets, I can see the Aussie remaining in the doldrums for the remainder of the week, but barring a catastrophe, I can't see it moving much lower. 84 certainly, lower than the 80 cents. It should remain here for a while.
Are we seeing a pushing out now of expectations for Reserve Bank tightening maps towards the November mark now?
Well, the interbank futures, haven't shown any change there. I think we're at a minus 7% probability of a 25-point hike. So they're not pricing in for a probability there. Our markets in particular, I think, are going to be reacting more on a short-term front, closer to home. SPI futures today indicating that we're going to follow Wall Street's lead and open up to 2% lower today. Certain sectors I'd want to focus on with commodities tumbling by their most in 10 months. I'd be looking at industry, metals, energy, those sorts of sectors. Anything to do with China as well. Don't forget, China's not only the largest consumer of industrial metals, but they consume largest consumer of soybeans, pork, corn, also cotton rather, the second largest consumer of oil, corn and sugar. All of those things very important to enterprise here in Australia, both public and private, so keep your eyes on that.
It was interesting, as mentioned, all those sectors, all of them on the 500 were negative overnight, but you did see that predictable, relatively speaking, better performance from the consumer staples and the healthcare plays. Is that going to be borne out domestically here today as well?
Yeah, and that's an interesting question. Also, you've got to follow up. You were talking about a 1-2 punch overnight in the US. We might potentially see a bit of a revision on that resource super profit tax today also. So that's quite an interesting how that's going to play out in the markets. Look, the only bit of data we got today, interestingly enough, is RBA credit, and that's important in terms of consumption. Looking for private sector credit to remain sluggish. Can't see an increase in lending to households, that to remain subdued. But business lending, no reason why it shouldn't be okay. You know, business conditions here in Australia arguably quite high at the moment, so we'll be looking out for that at 11:30 today.
We've got new home sales data, I do declare, as well to bake into the mix.
Yes.
We do. Let's not forget that one. It's 11:30 Eastern. Just back on rates briefly, a note crossing the wires from from RBC Capital Markets, quoted by Dow Jones News Wires, talking about a tightening on rates in August, saying inflation's sticky.
Yeah, inflation's certainly what they're going to be keeping their eye on, and again, that private sector credit that we see today is going to start to massage those expectations around what's going to be going on with inflation going forward. But you know, as long as prices can remain subdued, you know, again, I think that's going to hold the RBA's hand. Again, they're facing you know, headwinds from some of the machinations going on in Europe and the rest of the globe also.
Simon, belt up and have a good one.
Nice to see you.
Talk soon. Simon Mariner there from Aliom Financial. Let's